The stock tends to move for 3 to 5 days and then retrace for 1 to 3 days. Retrace for 1 day, open the next day right at the moving average, 5 moving average. What if it only moves up for 3 days? Man, ain't that going to suck? No, it's not going to suck for me because I stayed in the trade. Why did I stay in the trade? Because the faith in what I have been taught, in what I have observed countless times, is that in fact when a stock moves off of a moving average, it tends to move in the direction of the trend for 3 to 5 days before retracing for 1 to 3 days, and when it encounters an area of potential resistance, it tends to move through that resistance based on the momentum. And, oh, by the way, just in case you're thinking, well, he's pretty cocky and he thinks he knows everything. Nope. I have a stop. Why do I have a stop? Because I've been wrong before. There are times where the stock only moves for a day or two and then pulls back. So, guys, the key to success in trading in the markets is you have to let the winners run. You cannot continually shut down your winning trades with a small profit and expect that you're ever going to be profitable trading. There used to be an instructor that many of you know who used to say that the key to success in trading was to take small profits consistently over time. Bull crap. I'm going to call it out. That was the biggest bunch of crap, nonsense, garbage, BS that I've ever heard. And I proved it. The whole logic was you couldn't go broke making a profit, and I did. And here's how. You make $100 profit. Trade goes in your favor, and you're like, oh, I made $100 profit. Okay? All right, congratulations. How much did you have at risk? I don't know, pick a number. How much did you have to have at risk to make that $100 profit? Let's go look at some trades. Apple, we looked at Apple earlier. You go in, you buy a put option at $99. If it goes up to $99.60, you're out of the trade. 30 cents. Okay, 30 cents. So the trade started going in your favor, and you got out. You were like, I've got my $100. I'm out. I'm out. Okay, great. You're out. How much did you have at risk? You made $100 as the stock went down. That was your reward. How much did you have at risk? 30 cents, 10 contracts. I'll help you all out. How much was your risk? $300. You had $300 at risk to go out and make $100. Oh, well, Bill, you know what? I'm gonna tighten up my risk. I'm not going to have that tight. Okay, so you're going to guarantee you get stopped out more. That'll work more frequently, right? Let's say you got $100 risk, because I love it when people are like, I'm just going to do $100, right? Okay, all right, we're good. All right, so you go out and you do the trade, and that one on Apple started going in your favor, and you jumped out and you made $100. Good job. Okay. Now you got to subtract commissions, and you also got to subtract maybe some bid by ask slippage, right? So you really, what you made when you made money on this, you didn't make the full 100. You're gonna make, let's call it 93. Yeah, it was 1%. So it was the dumbest. I mean, wish I knew then what I know now. Okay, you made 100, but there you go. Okay, so you really made 93. So there you go. And let's first go off of the fallacy that you're going to make money half the time and you're going to realize your maximum risk half the time, right? So you're going to make money on half of your trades, and does anybody do that? Very few. Okay, very few people actually make the money on half of their trades, their directional trades. Okay, so here's what ends up happening. Well, you know, Bill, it's not that big a deal because I took a $100 loss, right? I lost 100. Well, actually, you did not lose 100 because you paid for commissions, okay? And you're also paying the bid and ask. So the bid-ask slippage there, right, means that you actually lost, in this example, let's call it 107. All right, so you tell me, How's this I'm going to take small profits crap going to work out for you? When you're making money, you're making 93. When you're losing money, you're losing 107. How's that going to work out? It's not. That nonsense does not work. Even if you're right 50% of the time, which the vast majority of professional traders are right maybe 40% at the professional level. But if you're really, really good and you're right 50% of the time, you're making 93 bucks and then you're turning around and losing 107, making 93, losing 107, making 93, losing 107. How's this going to work out for you? That crap does not work. You have to let your winners run. Here's why. Let's take just a 4-to-1 reward to risk ratio. Let's this stuff, we look at this, we're like, you know what, that doesn't work. And when I was taught that stuff, one day I put pencil to paper and I was like, well, no freaking wonder I'm going broke. This is stupid. Doesn't work. Let's take the 4-to-1 reward to risk ratio. Let's say that on average, every time you do a trade and you're right, you make $4. And every time you get stopped out and you're wrong, you lose $1. Okay? And let's just go through the process here, and let's say that you make, well, let's just say that you're really bad, right? I mean, you lose $1, you lose $1, you lose $1, you lose $1, you lose $1. Man, you're really good at losing dollars here. 1, 2, 3, 4, 5, 6. Oh. Man, you did 10 trades in a week and you lost $1 7 times. You suck at this. This is awful. Well, of the 10 trades, only 3 of them made you $4. You made 12, you lost 7 because you let your winners run and you cut your losers short. How did your week turn out? I'll give you all a minute to formulate your answer there. How'd your week turn out? Did 10 trades in a week, you were wrong 70% of the time. How'd it come out? Yeah, you're up 5. That's called profitability. This is what most traders do not do. They got the chicken little complex. Oh my God, Amazon's going to go down. This is terrible. It's awful. It's going one candlestick. It's all going to go against me because I'm in it. And no. That is conventional thinking. That's thinking like everybody else does. In order to achieve greatness, you have to think great things. You have to think greatly. Amazon is a swing trade. I am now hooked to a winner. I'm not letting go early because I get scared out by some irrational fear that this thing is not going to work out in my favor because I'm involved and the market maker knows it's me and they're just picking on me and all of this other crap that goes through your head. My faith in what I have been taught and what I have observed for better than a decade tells me that this stock is most likely to continue running, that if it continues running, I need to stay with it, and if it does not, I will get stopped out at a small loss, a small impact to my total account value. That, guys, is and I know I'm spending a lot of time on it, but that is probably one of the most important lessons that I can ever share with anyone with regards to trading. People, the vast majority of people lose money trading. Over time, the vast majority, something in the area of 85%, lose money trading. And if you want to know why, it's because they don't do this. It's because they don't let the winners run. Eventually, most traders get to a point where they have the importance of cutting the losers short, but they don't balance the equation. They never get to the point where they can let the winners run. And I'll tell you, the hardest thing in the world is to stay with a good trade. It's not to get out of a bad trade. Eventually, you learn to do that or you go broke. But staying with the good trades is the harder thing to do.